Hello, everyone. Very good morning. Hi, good morning. Hi, Monu. Hi, Jatinder. Hi, good morning. So we're just going to wait for maybe another 2 to 3 minutes for everyone to join before we start this particular class. So how are all of you doing today? I hope all of you are doing well. Today we are having the master class a little early on a Sunday morning at 10 o'clock. I do hope to see good participation. But just give me a hi on the chat, whoever's here. I see a few of you already on the call. So just give me a hi on the chat so I know who all have joined this particular call. Yes. Hello. Hi. So we're just going to be waiting for maybe another 2 to 3 minutes. So for all of you who are already on this particular session, you just have to give us some time for the rest of the people to join in. Hi, good morning. Yes, so hi Niranjan, good morning. So very good morning to all of you. Good to see you guys here. We are just gonna wait for another minute or so. You'll just have to give us 2 minutes. Hi Ruben, good morning. So we have Ruben and we have Niranjan, Jatinder, Monu. Yeah. So how is your Sunday going? Yes. Hi Subodh, good morning. Hello. Sorry guys, we're just gonna wait for a minute or so. We're just waiting for some more people to join and then we will start the call. We will start this particular masterclass. So how many of you are attending this class for the first time? Can you just, put it on the comment? Just give me a yes and tell me how many of you are joining this for the first time today. Okay. So today we have a very interesting topic lined up for you guys. I'm sure all of you are waiting for this particular topic. Hi, Anna. Okay, so you are joining for the first time. So both is joining for the first time. Okay, good to know. Okay, so today we are going to talk about the red flags that you should watch out for before identifying a stock. So yes, that's the detailed discussion that we're going to have, and I do hope you guys get some good insights in terms of how to identify the right stocks based on the red flags. Okay, Niranjan's also joining for the first time. Okay, great. Okay. Uh, yeah, I mean, so let me quickly introduce myself. Yes, hi, Josefa. Hello, Mr. Kapoor. Hi, good morning, Artwid here. Hello. Okay, so let me quickly introduce myself. My name is Namrata, and I've been working with Groww for quite some time now. We've been associated with Groww to create content, to do these master classes, to basically make all of you understand about the different aspects of investing, right? I think the whole intention of Groww is to really democratize this whole process of investing, and you can do that only by, you can do that only when you are able to impart enough knowledge that people are able to take decisions on their own, right? And that is what we've been doing. So in the last 1 year we've done multiple master classes where we've covered different topics. And previously the master class used to be it used to happen on the Groww channel, the main channel. Now we've started doing this on the Groww Academy channel. Now Groww Academy is a brilliant initiative by Groww to really teach a lot of interesting things to the investors in the easiest way possible. Yeah, and that is the whole intention why we try to make our topics, our content as easy and as easy to understand. So today, in this particular masterclass, also we have a topic lined up for you guys. And of course, you keep the questions going. Whatever questions that you have, keep it going. I have about, I'm going to be having about 15 to 20 minutes lined up for questions today. And of course, if I can see all of you, I can see the chats. So if anything that you want to communicate to me, you can do that through the chats. Now, I always say this in every masterclass that whenever we are doing a particular masterclass, we're using a lot of examples, right? So I just want you guys to understand that you should not take those examples as a recommendation from any of us, right? From Groww or from my side. We are not. We're just using that example to explain a particular concept to you. So please do not consider that as a recommendation or as an advice from our side. We are truly just using those examples to help you understand the particular concept that we are explaining. Okay. So this particular masterclass today is going to be in English. Now, what we do is we try to alternate. So we do 1 week English, 1 week Hindi. So the last masterclass was in Hindi. So this one is going to be in English. Okay. I'm going to take about 40 minutes to finish, to basically give my talk, and then we're going to have Q&A from your side. Okay. So let's get started, and let me just quickly share my screen with all of you before I start. So just give me a moment. Okay, I'm guessing all of you can see my screen. Yes, okay, great. Hi, Vinay Kumar. Very good morning. Hello, Sanjay. Good morning. So yes, so let's get started, and let me just give you this really interesting thing. So whenever we are looking at just give me a moment, guys. Yeah. So, when we're looking at our health, for example, right? Whenever we are looking at, we want to get healthy, what are the few things that we do? So I think all of us know that when we want to get healthy, we know that we should be eating healthy, we should be sleeping well, we should be exercising regularly, and all of that. But that's not the only thing that we do, isn't it? Apart from that, we would also do a lot of other things, like we would go for regular health checkup. Do you agree? I mean, I think regular health checkups are really important because they help us in identifying if there's a problem in any part of our body, right? And if we are able to identify that problem before it actually gets worse, then then we are able to control it. Correct. So, from a health point of view, we are doing these regular checkups. Similarly, even when you buy a car, for example, say it's a very good car, but we need to service it at regular intervals, isn't it? We can't just keep using it. We have to service it as well. So when things are checked at regular intervals, it's just easy to identify those risks, the potential risks, and maybe minimize that problem that could arise at a future time, right? So basically, what we're trying to do is we're looking for those potential problems. In the exact same way, if suppose we want to build a very good portfolio for ourselves, yes, all of us want to put in that effort, we want to have a beautiful portfolio which is giving us great returns, and we identify those good set of stocks. At the time of investing, it's possible that these companies look great, they're fundamentally strong, they have very good growth potential and all of that. But and all of us know that equities should be held for long term, isn't it? That is what we've been learning, that equities should be held for long term. Now the question is, what if something goes wrong in between, right? So what if you're holding it for long term, but during that duration something goes wrong, and then imagine losing out on all the returns and all the value that you've created because of a poor performance of a company, or maybe they've not done something interesting, maybe they've not they lack innovation. It could be multiple things. So just like how we do regular checkups for our health, for everything that we own, even for our stocks and our portfolio, we need to do regular checkup, right? So basically, when we are doing that regular checkup, that periodic evaluation, as we call it, and we'll be able to identify those red flags. And that is exactly what we're going to be discussing today. So in today's masterclass, we're going to be discussing how to identify those potential risks which could impact your portfolio in the future. Okay. So what exactly are red flags, right? So when it comes to investing in stocks, all we know it's an art, it's a science, it's a combination of both. The very first place that we look at when we're identifying stocks is the financial statements, right? In the last few master classes, we've spoken about all the financial statements. We've spoken about income and expense statement, balance sheet, cash flow statements, annual reports. We've done all of that, right? We've had a detailed discussion on financial statements. Now, it's a very good way to really assess the health of a company, correct? Financial statements give us a lot of insights. There is no denying that. But I just feel that, unfortunately, even with all this material which is available for an investor, many investors would still end up picking up poor stocks, right? And losing money in this whole process. more often than not, what you have to understand is that numbers on these reports are exactly what the company is trying to tell you. So, company is trying to tell you something through these numbers, right? And I think that if you can actually look between the lines, look through the numbers, you will actually get a lot of deeper insights. Yeah, so it's not just about looking at numbers as it is. You have to look at, what can be going on within the numbers. Okay, so these are called the warning signs or the red flags, as we call it. And they could help you in identifying those good quality stocks and maybe weeding out those poor performers. So red flag, it's a very simple indicator of the potential threats or the concerns or the areas of concern for you as an investor while you're identifying a particular stock to invest in. So, this whole concept started in the 1600s. In 1600s, whenever an army wanted to attack, they raised a red flag, and it's very symbolic, but that's what they did, right? And it's just a metaphor. So that's why red flag is used really just to show someone that there's a particular threat which is looming around, and you need to be you need to be aware of it. So firstly, there is no fixed method to identify red flags, that is for sure, right? There could be different approaches and analysis methodologies. And things like, you could look at, say, financial statements, you could look at economic indicators, there could be historical information, there could be some news items, there could be all of this happening to really give you that indication that there's some problem which is there in this particular company. So there are, we call them financial accounting red flags, then we call them economic red flags, then we call them financial ratio red flags, or you have corporate governance red flags. Yeah. So today, what we're going to be discussing, I've made a list of certain red flags that you should be aware of. Okay. So today we're going to look at those important red flags which can help you in identifying those certain important parameters. Okay. So, yeah, so as we were talking about the financial statement red flags, economic and corporate governance. So, the very first red flag is inconsistent revenues and profits. Okay. Now, when we're talking about this, so unstable earnings, right? So, I always say this for those of you who attended my masterclass in the past, I always say that consistency in returns is extremely important, right? If your returns are consistent, if you're looking at consistency in revenues and profits, that's a good thing in a company. So over the years, if there's consistency, if there's instability in earnings, right, it's probably one of those very important red flags to look out for. So when you look at these fundamentally strong companies, right, they will have consistent returns. They would show that increase in profit, increase in revenues, and you would see that year on year basis, right? If you see that volatility in profits or revenues, and obviously it'll get translated in the stock price as well, obviously. Now, see, there could be bad years. There's no denying that. There could be bad years where maybe the company is undergoing restructuring, maybe some form of expansions because of which there's some form of inconsistency in the numbers. But the overall picture should look good. Overall picture should be consistent, should be growing, right? So, for example, what you see on the screen is an example of VIP clothing. I've taken that stock, okay? Now, as you can see, the revenues were on a decline. So year on year, from 2019 till 2021, they've been on a decline. As you can see, if let me just maximize this for you. So this 2018, 19, 20, 21, right, and 22. As you can see, they've been on a consistent decline. Yes, but between 2021 and 22, there was an increase. And here also, if you see, as you see these numbers, what I'm trying to tell you is that it has not really translated into profits. If you look at the year on year profit, it has only been negative. So profits are these numbers, right? The second chart that you see, 2018 minus 3.07, 2019 minus 6.19. So the profits have been consistently negative. Now that is not a very good sign. Similarly, if you also look at the quarter on quarter charts also show a very similar picture. The revenues have been on a consistent decline. So in 2 quarters. So when there's no parity that's happening between, say, profits and revenues, that is where you look at that inconsistency, right? That consistency is what is going to help you in identifying a good stock. And if a picture like this is visible, may not be a very good sign. Okay. Now, I think the only exception to this particular red flag would be, say, commodity companies, right? Because They face inconsistent revenues because maybe the commodity prices have gone up. There's volatility in commodity price all the time, and that could be an exception, but not otherwise. Okay. Now, the second red flag is how you're increasing debt. Now, this is something that a lot of you would have, seen that, and we've discussed it as well. So when we're looking at companies, we're not saying, so debt is something that we generally say, no, very high debt is not a good thing. So debt in itself is okay. Some amount of debt is acceptable, right? And at the same time, I think it is required for a lot of companies to finance their growth plans. But of course, the companies have to put in money. They need money to stay afloat for their operations and so on. Now, if the company has too much debt and cash balance is low, which means they'll not be able to service that debt, then that's the problem. Yeah. So a big red flag is if the debt to equity ratio is on a constant rise, which basically indicates that the company's strategy for growth is through debt. So, which means they're aggressively financing the growth of the company only through debt, but they're not using the profits, right? And if they're not using the profits, but only taking debt all the time to finance the growth, then it could be a red flag, right? So, we also look at, say, the interest coverage ratio. Now that gives a better picture in terms of serviceability of debt, right? We've discussed it in the previous class as well. The interest coverage ratio basically tells us to what extent the interest component of the loan can be covered. Yeah. Now, most of the times when we're looking at high debt companies, it actually shows low corporate governance, or there's some corporate governance issues, right? And that's probably when the promoter really, he takes on heavy debt, goes aggressively financing through debt, and that could also reflect in the stock price. So, for example, a debt to equity ratio of say 1.5 to 2 is an indication that there's a problem in the near future. Debt to equity ratio should always be on the lower side. And when you see a debt to equity ratio of more than 1.52, that's when you should be a little more careful about investing in that particular company. So, for example, TVS Motor has a debt to equity ratio of 3.6, but the industry average is 0.48. Okay. If you look at REC Limited, it has a debt to equity ratio of 6.49 as of March this year, and the industry average is about 1.04. So you look at the difference here, right? The industry average is only about 1, but the company's debt to equity ratio is very high. Bharti Airtel, right? Classic example. The debt to equity ratio is 2.55, but the industry average is about 0.63. So that is why debt to equity ratio is something that you should be looking at quite closely when you're looking at identifying particular stocks. Okay. Next is auditors' reports and footnotes to financial statements. Now, I think this is one of those red flags which are very important but very difficult to identify, but it's a very important red flag. And if you can identify this, you'll actually be able to understand corporate governance wise what is happening. So the financial statements are audited by the third party, we all know that, right? And the third party, that particular auditor is looking at all the discrepancies, errors, all of that, yeah? And in the summary of misstatements, that's a place, summary of misstatements, where all this is mentioned, the discrepancies, the errors, and so on. Now, when you're reading the financial statement, this is a good place to look at the summary of misstatements. There have been cases in the past where auditors have actually colluded with the companies, and they have really made the report, the financial statements look really good. Yeah. There's a German company called Wirecard, which had this big scandal that happened in 2020. Okay. And in that particular scandal, 2 billion euros went missing from the books, with the long-time auditor, which was Ernst and Young. And they were suspected to, there was some form of malpractice happening there. So what you have to understand is that you should look at the summary of misstatements when you're looking at the financial statements. The footnote section also would help you to give details about certain form of anomalies happening. So, when we're looking at balance sheet, P&L, all of that, when you look at the actual numbers, you should look at the footnotes as well, because footnotes are a good place where you'll be able to identify these anomalies, where you'll not be able to look at these anomalies anywhere else, right? It's the footnotes which will help you in understanding these. Okay. So this is one of those red flags. Now, the next one is when the financial statements are very decked up. Yeah, what does that mean? So basically, if you see numbers which are too good to be true, that is where you should be a little more careful. Okay, so if you find numbers that are too good to be true, especially say when compared to peers, there's a sudden sale in jumps for a sudden jump in sales, right? Or say suddenly you'll see a sudden jump in the revenues in the previous quarter. If you see some sudden bumps happening in the numbers, then that is something you should be careful about. Okay, now you should be obviously careful about revenue manipulation, or the expenses can be misrepresented, and so that basically shows that management is trying to hide something. Okay, now common ways include, say, what companies can do is they record revenues before the actuals happen, right? So they can do this by selling to their sister concern, right? So they would show the sales in the sister concerns, and they plan to cancel it immediately. And that is obviously they're showing the numbers which are very good, but they don't intend to keep the numbers. They're going to cancel that sale number in the future. Or say recording the sales transaction which is tied to a particular condition. Say, for example, you're paying a particular amount in installments, but you're recording the whole value of sale. I know that's not how it should be done. Or say, for example, majority of the sales is happening in the last few days of the quarter. Yeah, I mean, just last few days you'll see suddenly jump in numbers, or sudden surge in, say, intangible assets or fixed or intangible assets. Suddenly you'll see, the intangible assets have gone up. So and of course, now these are the numbers that you can look at in the quarterly financial statements. In quarterly financial statements, if you see these numbers, you'll be able to get a better picture, right? So what I'm trying to say is that you look at these inconsistencies in the financial statement when you are really analyzing a company. Now, other income, right? When you look at other income, it's a potential red flag if what they've done is they've taken the reserves from the previous quarter and plugged it into this to really show good profits, right? Now, those are the manipulations which can be done. We call it cookie jar accounting. Yeah. So these are certain manipulations which are done, but they are visible in the financial statements. Okay, and that is where you need to be looking for these problems. So Satyam Computers, right? Classic example. All of us know about the Satyam Computer scam in 2009. And this is where the chairman actually confessed, saying that he tampered with the accounts and cash and bank, the bank balances. And as per the SEBI's report, there were misstatements to an extent of 7,000 crores for certain computers. That's a kind of misrepresentation that they did. So, tampering with the numbers is possible. Companies, there are companies that do it, and we obviously need to be careful about it. Now, the next red flag that we should be careful about is misrepresenting the expenses or the liabilities. Okay. I think a very common way of doing this is manipulating the inventory. Okay, so let me explain this in a little more detail. It's possible that a company would not record the full expense of the material that they have bought. Okay, now that's manipulating inventory, right? Or they're not writing off outdated inventory, which is no longer saleable. So it's no longer saleable, but it's still part of their inventory. Or say overcounting or undercounting inventory. We call it as phantom inventory. They're doing all this, right? You should look at very closely at such variances. So there was this Enron scandal of 2001. Now, that was one of the biggest accounting scandals, and when in this particular time, where there were huge debts, where they kept huge debts off the balance sheets. Okay, the company had over $60 billion in assets, and they finally filed for bankruptcy. $60 billion worth of assets, and they filed for bankruptcy. So there can be a lot of misrepresentation happening in terms of expenses and liabilities, which should be kept a track of. Okay. So just give me a moment. Okay. So now the next red flag is shrinking top line. Yeah. So let's understand this. Now, when we're looking at top line. So for example, if you see that the reducing operating or net margins, right? So net margins or the operating or the net margins, if they are coming down, even when the revenues are increasing, that's a big shout out. That's a big thing. That's like on your face, it's telling you that's a red flag. Okay. Because logically speaking, this basically shows that there could be you're losing the pricing power with the competitors. Yeah. If a company is showing 3 years or more of declining profits, it is not a good investment. Okay. It has to, your revenues and profits need to move in tandem. If the revenues are going up, even your profits should move up, right? It shouldn't be like your revenue is going up, but your profitability is coming negative. Okay. So, for example, the Trading Corporation, okay, it has been showing massive losses year on year, and in addition to it, it has a liquidity crisis, all of that, and you can see clearly that particular anomaly in these charts that you see on the screen. Okay, again, I'm just going to maximize the screen. So, as you can see in these particular charts, here I'm showing you the profits. The first chart is annual profit and the second chart is the quarterly profit. Okay, and this is for this particular company, the State Trading Corporation. Here, as you can see, we consistently see negative profits year on year. Also, it's just negative from 2018 to 2022. It has never gone positive. Even quarterly profit is only negative. The point is, even if your revenues are increasing, but your bottom line is not, your profitability is not, then it is something that is telling you on the face that this is not a good investment. Okay, so this is definitely something to watch out for. Now let's look at the next red flag. So, of course, there are a lot of red flags. I'm making a note of a few of them for all of you to understand. Yeah. So next is complex transactions. So, if you see the company doing a lot of complex transactions, right, with external or with internal parties, and the complex transactions could be, say, hedging, divestitures, all these, then they are, and they are doing these transactions without sufficient, say, economic standing. Like they don't necessarily need to do these transactions, they're still doing it, right? Then that is something that you should be watchful about. It's very simple. Warren Buffett said a very simple thing. If you do not understand the financial reports, the company doesn't want you to. And if the company doesn't want you to understand the financial report, it basically means that there's something going wrong. Okay. And all these complex transactions are very difficult for people like you and me to understand. Okay. And if there's a lot of focus on these complex transactions in the financial statements, then you need to be a little more careful about investing in that company. Okay. That is definite red flag in this particular case. Okay, the next one is rising inventories or, say, receivables. So if there's a lot of money which is tied up in receivables or inventories, and basically it's the money which you cannot use, right, which is not generating any returns for you, either in the form of sales, profits, or in terms of investments, then that means that's something that you should be careful about. Inventories are important, right? But if it is constantly rising, so we always say that there is inventory turnover ratio, right? There has to be a balance there. If that ratio is constantly, if the inventory is constantly rising, which means you're not able to sell the inventory fast, right? And that means that is the money which is tied up, which is the inventory is there, you're not able to sell it, so you're not getting that, you're not able to generate money out of it. So that is a problem. So, for example, Godrej has an inventory turnover of, say, about 0.69. And if you look at, say, Gillette India, of an inventory turnover ratio of about, say, 0.72 in the segment of, say, personal products. And that is not a good thing. The inventory turnover ratio has to be good because the inventory has to move fast. Yeah. For example, if you get HUL is 1.91, Bajaj Consumer 1.9, and they're still relatively good. But a very low inventory turnover, 0.69, 0.72, that means the inventory is not moving fast and that is not generating returns for you. So look at that inventory turnover ratio in the financial statements when you are looking at when you're looking at identifying a company. Okay. The next one is volatile cash flows. See, cash flows of any company are really important because cash flows are going to help a company manage the short-term expenses, right? We all know that when we look at the cash flow statement, right? We look at cash flows. If we always say that if the short-term cash flows are not adequate, then there's going to be a problem. Yeah, because you can have all the jazzy plans in place, you can have all the strategy in place, you can have the best business model in place, but if you don't have money in the short term to manage your day-to-day expenses, to pay up the salaries, to service short-term debts, then you're going to have a big problem. Yeah. Now, there could be two scenarios: a lot of cash or very less cash. If there's a lot of cash, also, it basically means that your accounts are being settled, or there's not much work which is coming in, so you're not able to utilize that cash. Yeah. And if there's a cash shortage, that obviously indicates that you're not able to manage your operating expenses. So trust me, anytime we're looking at numbers, we look at a balance. The numbers can't be very high, the numbers can't be very low. If you see too much volatility in numbers, that is a red flag. And too much volatility in cash flows is definitely a red flag. Okay, it can't be very high, it can't be very low. There has to be the balance. Yeah. Okay. Now the next one is declining sales but increasing gross profit margins. Okay. So this is important because profit margins should not increase in isolation. I mean, they obviously have to go in tandem with the sales, right? So we always say that, say, your profit margins and your sales numbers should move in tandem with each other. If they don't, that means there is something going wrong there. There's something which is a problem. Okay, so they have to move in tandem with each other, which is for sure. Atypical accounting practices basically means you're not following the standard accounting practices, but you're probably doing some unusual accounting practices, which is probably acceptable from compliance point of view. But you are not following the standard accounting practices which should be followed, because then what you're trying to do, what the company is trying to do, is maybe there's some form of scrutiny that they're trying to avoid, right? Maybe they're trying to cover up the losses. Maybe they're trying to use tactics to, maybe they're trying to over evaluate the assets, or maybe they're trying to manage their profits through CSR activities, or all of that. So whenever you see accounting practices which are not standard accounting practices, okay, ideally they should be standard accounting practices, but if they're not standard accounting practices, it basically means that the company is trying to show you a different picture which is not real. Okay, so that is what you should be looking out for. Now, next, very interesting. Okay, volatility in market price. Yeah. Okay. For example, market price is dependent on investor sentiment. All of us know that, right? So, if the investment sentiments are positive, you will see market price of a particular stock doing well. But if the investor sentiment is not that positive, the market price also gets impacted. Yes. Now, market price can be manipulated through large investor holdings or promoter holdings. Okay, when the promoter holding is very high, even a small trade can actually have a big impact on the price, and too much volatility is what you should be careful about. So, for example, a very classic example is Vedanta's promoter, Mr. Anil Agarwal. He's a promoter, right? And he bought shares of his company and the share price started doing well. So he basically did this so that the share price starts doing well. So he had increased his holding in the quarter ended, say, December 2015, and that had a big impact on on the stock price or the share price. So when the promoter holding is changing drastically, it is going to have an impact on the market price, and promoters can actually increase their holding because then it'll show positive sentiments. They're buying more shares, and it'll obviously have a positive impact on the share price as well. Okay. Now, the other thing is also pledging in promoter holdings, right? So, when we say promoter holding, for example, promoters know inside of the companies really well. They know how the company is doing, they know everything about the company, right? And they know what's happening inside. So, now if there's change in the promoter holding, it will show you as an investor the confidence the promoter has in the company. So, logically speaking, if the promoter holding is there should be a decent promoter holding. Yeah. Now, for example, if the promoter holding is going down, it means the promoter in itself doesn't have a lot of confidence in the company. Yeah. So, Yes Bank, for example, I'm showing you the chart as well. The promoter holding went down from near 20% to almost zero in March 2020. So, over 1 year, as you can see, the promoter holding went down from 20% to almost, say, just about 1.5%. And that is the time we actually saw the stock price. It went down from 270 in 2019 to 12.75. Yeah. So promoter holding, if it changes very drastically, right? If you see that suddenly promoters have sold a lot of their stakes, that means the promoter doesn't have confidence in the business himself. And that is what you should be watching out for. Now, there are two types of businesses, right? Not every business you will look at promoter holding. They are family run businesses or family owned businesses, and then you have professionally run businesses, right? So if you look at family owned businesses, percentage of promoter holding is important. In professionally run companies, there is no promoter holding. Okay. So, for example, if you look at the price of a company, right, with high promoter holding, so which basically means low free float, it's easier to influence. Yeah, it's very easy to influence when the promoter holding is large, because it's say for example, if there's a company which has promoter holding of 99%, which means free float only 1%. Now that 1% is very easy to manipulate, right? And it also impacts the liquidity. Yeah, so when you're looking at promoter holding for family run businesses, promoter holding is important. But say professionally run companies, so likes of say ITC, LNT, all the professionally run businesses, they have no promoter holdings, and then that's okay. Then you don't have to worry about that aspect, the promoter holding aspect. Also, pledging, by the way. So, what is pledging? Pledging basically means that a particular company can take loan against the shares. So, if you see promoters actually pledging their shares, then it's something that you should be careful about. And all this information is there in the financial statement that you'll be looking at. Okay. Next is FII holdings. Okay. Now, what are FII holdings? So, foreign institutional investors. A lot of people believe that so there are two ways to look at it, right? When we're looking at FIIs, it's not necessary that a lot of FII holding is a good thing. Not necessarily. It just depends on, if, for example, in India, we have about 1,755 FIIs, which are registered in India, and not all of them are long-term investors. So some people believe that if there are a lot of FIIs who've invested in a company, it's a good thing. Not necessarily, because they mostly they would probably be looking at some companies from a very short term point of view, right? And if they're looking at from a short term point of view, it may be irrelevant for you as an investor, because all of us would be looking at long term of investment in a particular company. Then you have legal cases and tax issues. Okay, now when we're looking at legal case and tax issues, it's an obvious red flag, isn't it? But it's an obvious red flag which many people tend to miss. So displaying all this information is mandatory. So in the financial statements, in the annual reports, you will see pending lawsuits, or all this form of information is mandatory for the companies to display in the annual reports. Pending lawsuits are there, or any tax related thing. Say any lawsuits against company directors. All these are red flags which are visible in the annual report. You can see it. Again, you should look at this aspect, because I truly believe any company is an indication of the people who are running it. If you have good people running it, the company will do well. But if you have lawsuits against the directors, against the management, it's an obvious red flag. Yeah. Okay. Then we have poor corporate governance. Yeah. I mean, I can't tell you the number of examples we've had in the recent past of companies which are fundamentally good, but because of corporate governance, they've goofed up. Yeah. Because, corporate governance is important, and a lot of companies just, they tend to, they tend to make a lot of mistakes from a corporate governance point of view and actually just spoil the whole game of business. So it's very subjective, but corporate governance is a foundation on which any company is built. And that ensuring that there's transparency is very, very important. So some potential red flags from a corporate governance point of view could be, say, there revenue leakage is happening. There's suspicious attempt to influence the stock price, or say there are unethical business practices, or say there's lack of alignment with a minority shareholders interest, or say window dressing, or aggressive accounting practices, low employee welfare. All these are indications of bad corporate governance. Okay. And corporate governance is truly something that we should be watching out for. Now, other typical red flags that you could look at, apart from the ones that we've already discussed, say there are any large adjustments which are made late in the year, and they want to make amendments, or inaccurate data is there. That's what you should be looking for. Say there are significant changes in the senior management. So in the company, the senior management changes significantly. That's a red flag. Say latest news report which indicates, say, heavy changes in the environment, or say the target audience of the company is under scrutiny. or say economic red flags like war. Yeah, so if there's a war happening, all of that, all these are red flags apart from the ones that we've already discussed. Okay, so guys, just to conclude, and now of course we've discussed so many red flags. I think analyzing the financials is a skill which requires time. Obviously, you need a lot of patience. You need to really look at the numbers, go inside, understand this in detail. But obviously, the list that we've spoken about is not exhaustive. There are multiple other things that you could look at. But of course, this is a good indication. So what I've shown you is a good indication of your starting point. Okay, I would say don't get too carried away by multi-baggers. Okay, but keep things very simple. Red flags mostly appear in the quarterly financial statement. So we generally say that you look at the annual financial statements for numbers, but for the red flags, you look at the quarterly financial statements, and typically look at multiple quarters when you're looking at the financial statement. Look at the variation in numbers over multiple quarters. With time, I would say there have been significant improvements. There's no denying that. A lot of improvement in the accounting practices. Regulators have become more strong. Regulators have become more compliance oriented. They oversee financial transactions records, all of that. And I think with the digital world, things have obviously gotten easier. But while this is definitely a reason for hope, but I still think due diligence from our side as investors is very important, because we need to protect our portfolio more than anything else. Yes, so that is what we should be looking at. So now let's look at. So now I'm going to take some questions. So whatever questions that you guys have, please feel free to ask me, and I'll be more than happy to answer those questions for you. So just a minute, yeah. Yes, okay. So any questions, guys? Let me see what questions do you guys have. Okay. I want to start a business. What do I do first? Please do ask me questions which are more relevant, to the topic that we are discussing. So, how should we approach these red flags? I mean, how should we respond to them from a long-term point of view? Okay. So, see, when we are looking at red flags, um, it's not about responding to these red flags. Red flags are going to help you in identifying if you know they're going to help you in understanding if a company is good or not from an investment point of view. And if you already invested in a company, then you need to be cautiously tracking these red flags, right? So how should we respond to them? If you see some very big red flags, then obviously you need to either not invest in that company, or you need to clearly move out of it, right? Because red flags are eventually telling you that there's a particular threat which is there. And if there's a particular threat, then you need to be careful about it, right? Some really big red flags that we've discussed, in terms of inconsistency in returns, sales and profits not being in tandem with each other, problems with corporate governance, all these are very strong red flags, right? And if you see these red flags in a particular company that you've invested in, then clearly you need to move out of it, because before something big happens, you need to be out of it. Like, imagine Satyam Computers 2009. If for a lot of investors who were able to figure out the red flags before the scandal happened, actually didn't lose out on too much, right? So, which is why I always say that when you're looking at red flags from a long term point of view, of course, keep tracking your portfolio. You don't need to track all your portfolio on like month on month basis, but at least once in 6 months, look at the quarterly reports and see if you've been able to see if you see any inconsistencies in the quarters, right? That is what you need to be looking for. Okay. Okay, again. Yeah, okay. So you're asking about pledging, Sabya. Okay, so you're saying that how can we comment for the pledge against the promoter's holding? Can we say if the pledge is more, it's a red flag? See, pledging, if you see a lot of pledging happening, as you rightly said, then that is a potential red flag, okay? Which means the promoter is using its stake to raise funds, right? And is that money getting translated in the business? If it is getting translated in the business to some extent, it's still okay. But if it is not, and probably the promoter is using that money for himself, then it's a problem. Yeah, that money needs to be reflected in the consecutive financial statement, and that money needs to be visible. But ideally, too much pledging is not a good thing. It is a red flag for sure. Is there any agency or site that does this identification of red flags easier for an individual investor? None as of now that I know of. No, I wouldn't know. Okay, red flags effective for long run or trading also. For trading, it might not be of great help. Mostly red flags are used for long term investments, right? So if you're looking at investing in a particular stock for the long term, that is when red flags would come in more handy. For someone who's trading, see, understand this, red flags are potential threats for the future, right? So if you're looking from a long term point of view, they're going to have an impact. In the short term, they may not have that much of an impact. So I'm saying in the short term, even if the company is not doing well, the stock prices still may continue to go up. Yeah. So not for trading, just for long-term investments, red flags are definitely important. Okay. Any other questions, guys? Anything else? How can we regularly watch that stock daily changes happened in the company? Okay. I'm not sure if I understand the question clearly. If you can just elaborate on your question, Harbans, that would be great. That would be helpful. Any other questions, guys? I mean, I do hope the session was useful. I do hope that all of you understand those basic red flags we should be looking out for. But then, of course, if you have any questions, please do ask. We have some time. And if there are no questions, obviously we can end the masterclass. But if there are questions, please do put it on the comments on the chat. Okay, so looks like we don't have any more questions. So great. So thank you so much, guys, for joining in today. And I do hope the session is useful. Please do keep coming back. Every week, we're going to have a different masterclass lined up for you with an interesting topic, which is going to help you become a more effective, a more powerful investor. So thank you so much. And I wish all of you all the very best. Thank you.